Billionaire investor Peter Thiel, widely known for his deep influence in Silicon Valley and his role in shaping modern technology investing, has once again drawn attention after making decisive portfolio adjustments that signal strategic patience rather than panic. Thiel built his reputation early by co-founding PayPal alongside Elon Musk, establishing himself as a bold entrepreneur with a sharp eye for transformative ideas. That early success laid the groundwork for a career that seamlessly blended startup innovation with disciplined investing, eventually leading him to become the first outside investor in Facebook, now known as Meta Platforms, and a co-founder of Palantir Technologies, one of the most influential data analytics and artificial intelligence companies operating today. Given this background, it is understandable why investors closely track Thiel's moves. His hedge fund, Theil Macro, recently disclosed through filings with the Securities and Exchange Commission that it exited all publicly traded equity positions. This decision stood out because the portfolio previously held exposure to several of the most prominent technology and artificial intelligence leaders in the market. Rather than signaling a loss of confidence in innovation, this shift appears to reflect a calculated response to a rapidly changing investment landscape. To better understand this move, it helps to examine how the transition unfolded over time. During Q3, Theil Macro exited its position in Nvidia, while also selling shares of Vistra and trimming exposure to Tesla. At the same time, the fund initiated new positions in Microsoft and Apple, suggesting a selective rebalancing rather than a wholesale retreat from the market. That strategy evolved further in Q4, when Theil Macro liquidated all remaining stock holdings and shifted fully into cash. Several factors likely influenced this outcome, including macroeconomic uncertainty and rising geopolitical tensions. However, developments within the artificial intelligence ecosystem appear to be especially relevant in understanding the timing and rationale behind these decisions. In recent quarters, major technology platforms such as Alphabet, Microsoft, Amazon, and Meta Platforms have openly signaled ambitions to vertically integrate their artificial intelligence infrastructure. This includes designing custom artificial intelligence chips internally, often in collaboration with Broadcom. At the same time, developers have increasingly demonstrated that they are supplementing Nvidia-based graphics processing unit clusters with alternative accelerators, particularly from advanced micro devices. While Nvidia continues to dominate the data center market, the rise of credible alternatives introduces new competitive dynamics that long-term investors must weigh carefully. Microsoft's artificial intelligence narrative also presents a nuanced picture. Much of the company's momentum is closely tied to its partnership with OpenAI. Although OpenAI's adoption has expanded rapidly, competition among generative artificial intelligence developers has intensified, with players such as Anthropic pushing the pace of innovation. Microsoft collaborates with multiple developers, but market perception often centers on its role as a cloud infrastructure provider supporting these efforts rather than as the exclusive beneficiary of their success. Complicating matters further, many large language model developers now rely on multi-cloud strategies to optimize cost, performance, and redundancy. Because Microsoft does not hold exclusivity over these customers, the competitive advantage relative to Amazon Web Services and Google Cloud Platform remains limited. This environment introduces uncertainty around relative growth rates within the cloud computing sector, even as overall demand continues to expand. Apple and Tesla share another common thread in the artificial intelligence discussion. Neither company has yet achieved a scaled enterprise-level artificial intelligence service that materially transforms revenue streams. Their initiatives, ranging from advanced consumer intelligence features to autonomous systems and robotics, are progressing steadily but remain in developmental phases rather than fully monetized platforms. Additionally, both companies focus heavily on premium products. While the broader macroeconomic outlook has shown signs of stabilization, interest rates remain elevated, and future policy decisions from the Federal Reserve remain difficult to predict. This uncertainty may temporarily discourage consumers from upgrading high-end smartphones or committing to major purchases such as electric vehicles, introducing near-term demand variability rather than structural weakness. Beyond traditional technology, the artificial intelligence boom has also fueled demand across adjacent industries, particularly energy. Power generation has emerged as a key beneficiary as data center expansion accelerates. Theil Macro initiated a position in Vistra during Q1 of 2025 and exited in Q3. Over that period, Vistra's share price climbed by 42%, reflecting strong investor enthusiasm tied to artificial intelligence infrastructure growth. That appreciation was driven largely by the narrative that Vistra could benefit from increased interest among hyperscale operators in nuclear energy solutions. While that theme may eventually play out over the long term, Vistra operates across a diversified energy mix rather than focusing exclusively on nuclear power. As a result, artificial intelligence-driven enthusiasm may have outpaced near-term fundamentals, making profit-taking a prudent decision. Taken together, these developments suggest that Theil has temporarily rotated capital out of equities during a period of elevated uncertainty. Geopolitical conflicts, an unclear macroeconomic outlook, evolving Federal Reserve policy expectations, and the approaching midterm election cycle all contribute to a market environment where short-term outcomes can feel increasingly unpredictable. From this perspective, holding cash represents flexibility rather than fear. Theil's approach highlights disciplined risk management and a willingness to wait for clearer signals before redeploying capital. Importantly, this strategy reflects the unique objectives and time horizons of institutional investors and does not automatically translate to individual investors. Historically, the S&P 500 has demonstrated remarkable resilience across decades, navigating recessions, geopolitical crises, political transitions, and monetary policy shifts. Institutional investors like Theil often blend long-term conviction with short-term tactical positioning, while individual investors typically benefit from consistency and patience. As a result, retail investors do not need to mirror hedge fund activity, as personal goals, timelines, and risk tolerance can differ substantially. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.